Welcome everybody to today's ELV webinar. We will be covering the final series installment of the Strengthening Business Practices trainings of the EQIT. This topic today is going to cover financial reports and internal controls. This topic specifically is going to be most helpful for center-based providers or family childcare providers with staff or multiple locations. So hopefully this will be relevant and important both now and in the future down the road, just to kind of have as a resource in your back pocket whenever needed. So for those of you who don't know me, I may be a familiar face here, at least on this domain, as a webinar moderator in place of my teammate Michael today. My name is Melena Boris. I am our marketing and membership specialist here at ELV. If you are new to ELV in general, we help out childcare providers kind of on the tech assistance and business admin side of things. So if you're unfamiliar, feel free to reach out to us. We're a 501c3 organization. So my email's right there if you're interested in learning a little bit more. If you're new entirely, feel free to do so. A little bit more. We are the Colorado integration for the Colorado resource platform here in the state. So we help out kind of with, it's kind of a nonstop shop for everything you could imagine really in the ECE industry for templates, assessments, toolkits, discounts, and savings. So if you don't already have an account on the resource platform, I'll be sure that this link is included in order for you to get an account and register for one. And it's actually free for all Colorado providers and ECE professionals through the end of 2020. So be sure and do that if you haven't already. It's a great tool there. And obviously, besides our Alliance course system that we run every day for our childcare providers, a few of the pandemic-related enhancements you probably all are already aware of is the touchless sign in and out for daily check-in and check-out for children, as well as the contactless temperature and health checks as well, just for more pandemic-related enhancements. So be sure and check those out if you haven't done so already. Additionally, if you haven't already followed all of our social media, we're on Instagram, Twitter, LinkedIn, Pinterest, YouTube, our website in general. So be sure and follow us on all of our domains to be kind of in the know and up to date on webinars like these, What's Up Wednesdays that I do on Wednesday, obviously, and then any kind of grants, resources, trainings, and things like that. Be sure and follow us there to just kind of stay in the know on all of those things. And just some normal housekeeping at the end of the webinar today, I will be sending out a post-webinar messaging that has the recording of the presentation, a copy of the slides as well, and some resources that Elsa and Alicia are going to be sending over as well. There will be a few polls to interact with today, so be sure and kind of just be aware. We'll be interacting a little bit with our guest speakers. And if you're watching on Facebook, we have a moderator over there. My colleague Brooke is helping me out today on that end, so she'll be sending the chats and any questions over there. So feel free into those comments on that end as well. All right, so without further ado, we've got Elsa and Alicia. You guys know them. They've been here several times before. Elsa's the Leadership Development Manager here at ELV, and Alicia works with us here at ELV and in general with the Early Childhood Partnership of Adams County. So without further ado, ladies, take it away, and I will stop my share.
Thanks, Melena. I will get into our beautiful slideshow. Is that full screen as it should be? Okay, thanks. All right, so welcome y'all to our fourth and final module of Strengthening Business Practices for Childcare Programs. We're really excited to be here with you today. Thanks so much to Melena and Brooke for handling the tech side of things. We appreciate you, and thanks for the lovely introductions. I'm Elsa, and I'll be going back and forth with Alicia for today's training. This session is really focused on how to build your financial reports and internal controls, skills, and knowledge. And this training was developed by the National Center on Early Childhood Quality Assurance with funding from the Office of Child Care and the Office of Head Start, which are both part of the Administration for Children and Families under the U.S. Department of Health and Human Services. So we're very excited to share this pilot curriculum with you. So during today's section, we will talk about financial reports and identify ways that they can help you to better manage your program's finances. And we'll also talk about what internal controls mean in a center-based childcare setting and how they can help strengthen the fiscal health of your program. So if you've been to some of our other training modules, you may recognize this slide. We do recognize that a lot of people get into this work because they love working with children and not because they love running a business. So we get that. We know that running a business might not be your passion, but we do want you to consider that the business side and the program side of your work don't exist separately. They're definitely heavily integrated. And without sound business practices in place, you might ineffectively balance business and program concerns, causing both to suffer. Without sound business practices, you might spend more time than necessary on the business side, which would take your time and attention away from the children and the program side. You might spend too little time on the business side, and over time, the resources that your program needs might become depleted. That can diminish the quality of your program or even jeopardize your ability to stay in business. So we know that sound business practices can help you to build a strong business so that you can dedicate more time and resources to the program. They'll also help you keep your doors open and to serve the children and families who want your services. Our goal today is to help you understand how fiscal management can help you operate a stable and sustainable business. We'll talk about the role that internal controls and financial reports play in supporting sustainability for your program. We're not looking to make you accountants or financial experts. We know that a lot of our programs tend to hire people to take on these tasks, but we do want you to begin to see that finances are just another way to tell the story of your program. We know that if we asked you to describe your program right now, what you do, how you do it, what new things you've started or stopped this year, you'd have absolutely no trouble. So your financials can help tell that same story using numbers, and they can also impact how you get further funding for grants and things like that, and also to help you just engage with whoever might be handling the detailed pieces of finance. So I'm going to hand off to Alicia.
All right. So normally we'd be doing this training in person, and this would be set up as a matching game. But today we're gonna actually do it through a poll here. So we're gonna put up some different terms, and then you can pick which word it's describing in the term. And these are terms that you'll hear throughout the rest of this session. So the goal is just to begin building awareness of the terms, so they aren't entirely new as we go through the session. So here they are. You can go through and read them and answer, and we're going to go through the answers. So don't worry if you pick the wrong answer. We're just trying to get it more interactive. Like I said, normally it would be a match game that we would play in person. So we'll give you a few minutes to get in those answers. Maybe it'd be helpful if I read them. So the first one is also referred to as a profit and loss statement. This report lists revenue, expenses, and net income for a given period of time. Number 2 is a 12-month period of time used for accounting purposes and preparing financial statements. The third one is everything with an economic value that the program owns. The fourth one is revenue minus expenses, also called the bottom line. And 5 is operating costs that tend to remain consistent from period to period. Examples may include salaries, rent, mortgage, and insurance. So again, just kind of some samples of what we're going to talk about throughout the rest of this session.
Alicia, we've got about 14 of the 22 participants, and it's stayed there. So we can go ahead and end it there if you want to go, or good deal.
That sounds good. Yep. So does Elsa need to stop sharing in order to share the poll results?
Nope, doing that real quick.
Oh, awesome. I didn't know how it worked.
No worries.
Oh, here they are. Okay. So also referred to as a profit and loss statement, this report lists revenue, expenses, and net income for a given period of time is an income statement. So we will be talking about what liabilities are and what variable expenses are too throughout this. So you can learn about both of those. A 12-month period of time used for accounting purposes and preparing financial statements is a fiscal year. And again, we will talk about bad debt, so you can learn a little bit more about that. Everything with an economic value that the program owns are assets. So again, we will talk about a balance sheet and forecasting. So you can learn more about those when we get through there. Revenue minus expenses is also called the bottom line, is your net income. So we will also talk about full-time equivalent and budget to actual. Operating costs that tend to remain consistent from period to period. Examples may include salaries, rent, mortgage, and insurance, are fixed expenses. And we'll also talk about cash flow statements and internal controls as we go through. So thank you for participating, everyone. Just a little to get you warmed up with kind of the stuff we'll be talking about today. So the next thing we'll talk about is just a little bit about how do you manage your finances. Think about what reports you use to manage your program's finances. How often do you review your reports? What do you learn from these reports? How do you ever take action after reviewing the reports, and what do you do? We will start the discussion today about just discussing those financial reports. On the screen here is a sample from ELV's resource platform, and this can help with these kind of reports and planning with some of these business things that we're going to talk about today, some of the how to help manage your finances. So let's see, there are some standard reports that can help you identify changes in your business and better understand and manage your finances. Regularly reviewing financial reports is necessary to help prevent financial surprises at the year's end. Every business decision you make has a financial implication. In your position, it may feel that reports are not relevant to you. That isn't true. It's best practice to review your reports at least quarterly. It's also best practice to separate your personal finances and your business finances so that you can actively manage your business success. Financial reports can be produced either using a financial software program or with help from a financial professional like an accountant or a bookkeeper. If you do use the ELV core system, that's one way that you can put in some of these reports and run those, or you can use the resource platform to find some more of those kind of reports. So let's start breaking down these reports one at a time. The first one is financial reports. So let's just start examining what financial reports are. There are 3 standard financial reports that we'll review. Each one has a specific purpose, and we'll look at each one in a more in-depth. But let's talk about why we're putting, why they're all important together. So there are 3 core financial reports that are used to manage business: income statements, balance sheets, and cash flow statements. These reports tell you different things about your child care program. They tell the story of how you're running your program. Instead of using words to describe what you're doing, they're just using numbers to describe what you do in your program. As discussed previously, all decisions made about your program have a financial impact. So why would these be important to you? The reports will show you where your program is financially and help you to make informed decisions about your business. The reports will likely be necessary if you need to apply for finances in the future. So if you're looking for grants or other financial, if you're talking to your accountant, those are things you'll need to know. As we just said, it's best practice to review these reports at least quarterly so you can be proactive and adjust if necessary. And for our next report, we're going to talk to Elsa about income statements. You're on mute, Elsa. Elsa, you're muted.
Oh no, thanks. So we're going to start with the income statement, which is also referred to as the profit and loss statement. So the report of many names, and it might feel familiar to you because it's very similar to a budget. It just involves actual numbers instead. So on an income statement, we'll see our revenue, our expenses, and our net income. And the income statement includes revenue or funds received, which might include tuition, it might include registration fees, it might include grants, expenses or funds spent, so that might include salaries, program supplies, repairs or maintenance to your facilities. And then net income, which is revenue minus your expenses and your taxes. So perhaps you've heard the term the bottom line or profit or loss. Those terms also mean net income. And that's the amount of money that you have earned after you've accounted for all of your expenses. So be aware that the net income number might not match the amount of cash that you have in the bank because revenue and expenses can take time to process. For example, you might calculate your income statement before you are actually paid by someone or the check hasn't been counted or processed by the bank yet. There are projected budgets that are similar to income statements since they both show revenue, expenses, and the bottom line. However, the difference is that the budget is the plan, while the income statement shows what has actually happened, how much income was received, and how much money was spent. So the income statement will tell you how much money your program has earned and spent during a specific period of time. It could be a month, a quarter, or a fiscal year. Quick reminder that fiscal year represents a 12-month period of time used for taxes or accounting purposes. For most center-based childcare programs, this might be the January to December calendar year, but it might not always be that. Your income statement will also show you your bottom line for a period of time. It's a necessary tool to support making informed financial and management decisions. The income statement is most useful when current information gets compared to another comparable time period. For example, the same time period in the prior year or the current budget. The comparison allows you to more easily identify any unusual differences that require further review. So next we will look at a sample income statement. So the example doesn't show details, but in the follow-up materials from the webinar, we'll include a detailed example template that you could actually use to create an income statement for your own program if you don't have one. But as you can see, as this example shows, revenue minus expenses equals our net income. The structure of this report will always show revenue at the top, expenses below, and then the net income. To make this a valuable management tool, you need it to show a comparison between two time periods so that you can look at the variation between them. For example, this sample report shows a comparison of May 2018 to May 2017, the same month in the prior year. So why is it so important to make that comparison? Because the numbers only have meaning when you see them next to others. Without a comparison, you wouldn't know if they are good or bad. You wouldn't know if you needed to take action. There are some other comparisons that might be helpful as well. So you might compare the current year to date compared to the same period last year. You could also compare the current month compared to the previous month. And that could be especially helpful if you expect to see similar numbers and you notice a big variance, and that might inspire you to take action. You can also compare each month of the current year, for example, January through May, to see how things have changed from month to month, and that can help identify trends or anomalies. And once you've identified that variance, you can think about its cause and decide if you should take action. You don't always need to take action, like perhaps your revenue in May 2018 was lower because you had a week of closure and you didn't have that week of closure in May 2017. So that's a really easy to explain variance. But then another really important comparison is the budget to actual, which shows the difference between what you planned and what has actually happened. So you want to make sure that you're comparing the same period of time for both the budget and the actual. And that particular report can show us if there are any big differences between what you budgeted, what you planned for revenue and expenses, and what actually occurred. So knowing how much that varies and why the actuals are different from your budget can help you to make those necessary adjustments to your business. For example, trying to cut your expenses for the next month. You might also decide you'd rather tackle it by increasing revenue, by fully collecting tuition or charging additional fees to help improve revenue. And in the follow-up packet, we will send out that detailed sample income statement again so that you can really get into the nitty-gritty details. And I will hand it off to Alicia for balance sheets.
Okay. So some of you might already use balance sheets for your program, but it's best practice to review these balance sheets at least quarterly. Reviewing the balance sheet will help you to understand the long-term health and sustainability of your business. Let's talk about more about what's on these so you can begin to understand why it's important to use them. A balance sheet includes assets, meaning what you own that has value. So when I say something has value, it can be things like cash, the buildings you own, equipment, any of those things that have value in your program. Now, you can tell that it has value. In accounting, this is sometimes considered to have value if it can be sold or generate cash that could then be used to pay for the commitments or the debts you may have. So if you're thinking about your assets, just think about things that could be sold to make money back. A balance sheet also includes liabilities, and this is what you owe. So there are financial responsibilities that the business must repay, such as debts or other commitments you've made. So those are things like credit card debt, a business loan, payments for annual insurance coverage, a car loan, your mortgage, those kinds of things. A balance sheet also includes equity or net worth, which tells you the value of your program. To calculate your business's net worth, total all the assets you have, so all of the things that you own, and then subtract any liabilities, all the things that you owe. If you used all your business assets to pay back all your business liabilities, you would be left with the remaining value of the business or the net worth. This would represent the equity that you have in your business. So consider this as an example. If you own a home, think of the equity that you have in your house. The house is considered an asset because you would be able to sell it for some amount of money, so it has value. The mortgage you have on your house is the liability because you owe that money to the bank that they lent you when you initially bought your house. When you subtract the value of the house, the asset, from the balance of the mortgage, the liability, you're left with the equity or the net worth of your house. So that's how you would get your net worth. If you sold the house and paid back the remaining mortgage balance, you would have money remaining, and that would represent your equity. The balance sheet tells a story of what the program owns and what it owes at one moment in time. It's a summary of the financial history and health of the business. A balance sheet is different than the income statement in several ways. The balance sheet shows assets and liabilities, where the income statement shows income and expenses. The balance sheet is a snapshot of information about assets and liabilities at one moment in time. For example, the balance on your checking account on the last day of the month would be recorded on the balance sheet as an asset. As we discussed on the last slide, information on the income statement is cumulative over a period of time. For example, the total amount of tuition revenue that business has earned over the past month. To further explain this, let's use a car loan as an example. The income statement would show the total amount of payments that you have made on your car loan for the past year. The balance sheet would show the remaining balance that you owe on the car loan as of a particular date. In addition, the car would be recorded as an asset on a balance sheet. The car has value and could be sold to generate cash to pay some portion of the car loan if necessary. So it's an asset. The balance sheet can help you understand the financial health of your business. A business that has more assets than liabilities, that is, the more it owns than it owes, can pay for its upcoming financial commitments without going further into debt. A business that has more liabilities than assets, that is, it owes more than it owns, may struggle to meet its financial commitments and end up further in debt. It may be unable to sustain itself. A business goal for you could be to have assets that are at least 2 times as much as your liabilities. This means that you'll be able to cover all your liabilities owed and still have some assets remaining. For your net worth, this is a sample early childcare education balance sheet. So again, it's just a sample, like Elsa had the one before. When we send out our resources, you'll get more. This shows the overall structure of a balance statement and the major categories on the report. You'll notice assets minus liabilities equal your program's net worth or equity. What you own minus what you owe equals the remaining value of the business. Again, the structure of this report will always show assets at the top and liabilities below, and then the equity or your net worth. One of the most valuable ways to use this report is to compare 2 time periods, then review the line item difference between them. For example, this sample report shows May 31st, 2018 and May 31st, 2017. Reviewing the differences from one period to another will allow you to identify patterns or trends and that require your attention or action to correct. So you can see where your assets are at and where your liabilities stand. And now Elsa will talk about what a cash flow statement looks like.
I think I actually unmuted myself this time, so that's great. So the cash flow statement tells you what cash is coming in and going out of your program. And as you're probably highly aware, as a business owner, you must have cash flow to pay your expenses, your vendors, credit cards, mortgage. And it's critical to monitor that availability of your cash, what is coming in and what is going out. You need to know how much you have available to pay for future expenses. So what happens if a family is late paying its tuition? So the program wouldn't have that cash on hand to pay expenses. And if in addition to a late payment, a different family gives notice that they are moving out of the area, you would have even less cash available for those future expenses. Many programs have a dip in enrollment during the summer months, and that can reduce cash flow as well. A cash flow crisis can occur quickly. It can take only a few incidents to trigger it. Using a cash flow statement can help you to better understand the trends in how cash comes in and leaves your business. This understanding will help you to plan for those months when the cash coming in drops. There are both short-term and long-term solutions to a drop in cash flow. Some solutions might be collecting tuition in advance of providing childcare, building up a cash reserve, charging fees to reserve slots during summer months when parents take children out of care. You might also establish a line of credit with a local bank for use in an emergency. So the cash flow statement will include the cash in and the cash out, and the cash remaining to pay bills, buy supplies, purchase food, and pay debt, or take care of any of your other expenses. The cash flow statement will help you understand how much cash you should have in the bank. It's the story of how much cash has flowed in and out over a particular period of time, like a month, a quarter, or a year. So the cash flow statement is different from the income statement. You might have revenue that appears on your income statement because you billed the family already. However, until you actually pay, you won't see that the cash flow came into your program, and you won't be able to use that cash to be able to cover upcoming expenses. So that cash flow statement helps you understand how cash moves through your business and help you plan for the cash that you need to pay your expenses. So we'll take a look at a sample, and again, we will include a detailed sample cash flow statement in the follow-up materials. So there are different ways that this report might be presented. This format is pretty simplified. At the top, you can see the cash received during the month. That might be different than the amount of revenue you earned that month, but it's the cash you actually received for tuition or other sources. You may have earned revenue, but not yet received the cash. In the middle, the cash paid out is the actual cash that has left your bank account. If you wrote a check for something, but the money has not yet been drawn from your bank account, it would not be included here. So it only counts things that have actually been paid out. So the cash received minus cash paid out equals net change in cash. And that net change in cash can be positive or negative. Positive cash flow means you brought in more cash than you paid out. Negative cash flow means you brought in less cash than you paid out. And you'll likely have some months during a year where you have negative cash flow. That is okay as long as it doesn't happen every month, and if over time you have more positive than negative cash flow. Finally, you'll take the cash balance that you had at the beginning of the month. If it's a positive cash flow, you will add. If it's a negative cash flow, you'll subtract the net change in cash to see the cash balance at the end of the month. And that cash balance should match what's on your balance sheet. And then now that we've gone through our reports, we would like to do a quick knowledge check with polls from Melina.
All right, let me get those going. I have one quick question before we move to the polls. So yeah, you did show a balance sheet, which was great because we had a question come in about that. But is there an easy way to drive a balance sheet from a P&L statement, or are those two completely different things? Is one of the questions we got.
It depends on how you're handling your finances. I think some software programs probably will do it pretty automatically for you. If you're doing them more by hand, there are some things that are comparable, but some that don't quite match up.
Gotcha. Okay, let me get those polls going for you.
Thanks, Melina. Good question. So it's another kind of matching activity. So it's not a trick one. Each answer will only be used once, so that should help you to narrow down. But the first question is, which report includes beginning cash balance, net income, net change in cash, and cash balance end of month? The second question is, which report includes registration fee revenue, net income, program supplies expenses, tuition revenue, and accountant fees? And the third question is, which report includes assets, equity, and liabilities? So we'll give you a minute to get answers in there, and I think Melina can see when most people have gotten those in. All right. So great job on that first question. The majority of people got that correct. So the beginning cash balance, net income, net change in cash, and cash balance end of month will be on that cash flow statement. On number 2, we also have the majority of people getting that correct. So that income statement will reflect the registration fee revenue, net income, program supplies expenses, tuition, and accountant fees. And then that final question, assets, equity, and liabilities, will show up indeed on the balance sheet. So if you weren't quite sure on those, we will send out again those detailed examples that should help to clarify things as part of the follow-up materials. And if you're watching through Facebook Live, just make sure to register so that you get those materials as well. And now I will hand over to Alicia for internal controls.
Yeah. Okay, so the term internal controls is not one with which many people are familiar. I wasn't familiar with it before either, but a very simple example of an internal control is reviewing your bank account statement each month. So this is an internal control because it helps you to ensure there are no mistakes in the bank statement. If you weren't reviewing your bank statement monthly, you may not realize that a mistake had been made and that you could have significant financial impacts to your business. Strong internal controls will protect assets and prevent mistakes. They'll protect assets. Remember when we looked at the balance sheet, the assets on the balance sheet were cash and equipment. Internal controls are put into place to protect your assets. And it prevents mistakes because we're all human and mistakes are bound to happen. So internal controls exist to help catch those mistakes before they negatively impact your program. For example, what if you charged a parent $25 instead of $250 on their statement for their weekly tuition? If you were regularly reviewing your income statement, you would probably notice that error. Or maybe you forgot to make a deposit in your account. So just checking those things checks that you're doing what you need to do to keep your business going. What if there was a mistake on your credit card, or if the bank overcharged your fees? Would you be able to catch these mistakes if you weren't reviewing your reports regularly? Internal controls can't catch everything, but you need to do your best to control what you can. Processes and procedures should be detailed so that someone could step in and understand what to do. Processes and procedures provide clarity so that expectations aren't miscommunicated or misinterpreted. So think of your internal controls as a continuous cycle of managing risk for your program. You begin by reviewing your current business practices and policies to identify if there are any areas of risk that you may need to manage. Once you've identified a risk, you'll want to make changes to reduce that risk. You want to communicate the changes that have been made to your other individuals who are involved in the process. So example, you may have an assistant who needs to understand the changes, or perhaps someone else living in your house that needs to know, or working in, if you have a person in your business that does the financial review, then they would need to know. As needed monitoring the revised process to ensure it is effective and the risk has been reduced. Identifying risk is an ongoing process. You should continue to review and assess the business for the risks so that you're always managing and reducing possible problems. Think back to the original example of the bank statement. Here's how the process might look. Review processes and assess risks. You identified that you did not regularly review your bank statement and felt that this was a risk to your business. Make adjustments to manage risks. You establish a new process to review your bank statement monthly. Communicate new processes to others involved. So you let your family members know in the house to make sure that the bank statement is given to you when it arrives in the mail. Monitor the process. You review the bank statement monthly and alert the bank to any errors that you find. Now that we all have a better understanding of what internal controls are, let's talk more about what they look like within your business. So some examples of internal controls are listed here on this slide, but it doesn't cover everything that could be an internal control. So some of them are accurate and timely financial reporting. Financial reports should be reviewed monthly to catch possible errors or omissions. Adjust to improve the bottom line cannot be made if you're only reviewing these reports at the end of the year. Written policy and procedure manual. Written policy and procedure manual can set expectations, clarify processes, maintain compliance with law, and provide continuity in the event that someone needs to be out or unexpectedly. So if you needed to be out and you're the one that normally does this, you would have a process in place so someone else could step in and do it for you if needed. Written parents policy handbook. A written parent policy handbook helps manage risk, manage payment issues, and ensure parents understand what to expect on their business relationship with you. So tuition, when tuition's due, all those kinds of things. Separation of duties. manages risk by engaging more than one person in business activity. This practice reduces the risk of error and fraudulent behavior. So an example would be one person can create a check for payment, and then the second person can review it for accuracy and sign the check. In this example, the risk is minimized by having a second person verify the invoice or payment to make sure it matches and then sign off on it. Authorizations and approvals. This is a process that requires either prior approval or authorization from a second person before certain business activities can be completed. So an example of this would be creating a maximum amount that the program would allow staff to spend to receive a reimbursement on it. Any expenditures higher than that maximum amount would require approval or authorization from an administrator prior to purchasing that. Organized record keeping. The following are some practices to ensure organized record keeping. Ensure income, checks, and cash are deposited to business accounts in a timely manner and deposit match the financial reports. Maintain receipts for business expenses and keep them filed in particular order, like by date, is the best way to do that. Keep copies of contracts with families and file them in particular order, such as last name. Maintain business licensing and other important documents and file them in particular order. Another good way to do this is by date. Equipment and furniture records. So create and maintain a record of equipment and furniture to serve as a historical record of the assets that belong to the program, including the date of the purchase with anticipated date the item will need to be replaced, warranty information, and where the program can find that item in the building. So say it's the refrigerator or something like that, you would put all of those papers together and list it's in the kitchen. And then some businesses set a minimum dollar value for that equipment so that you're doing maybe things that are over $500. So you're not listing every little thing in that could be an asset, but things that are substantial. Data protection. Your program has a responsibility for ensuring the safekeeping of personal information shared by your families. An example of personal information is credit card numbers, bank account information, their addresses, things like that. Data protection should be considered for both paper files and electronic information. Examples of data protection internal controls include strengthening your online passwords, locking file cabinets that have any personal information in them, limiting the number of staff who have access to personal information, and prohibiting the use of email to send or receive credit cards or social security numbers. It's also important to know that the Individuals with Disabilities Education Act, Part B and C refer to information pertaining to the confidential requirements of personal identifiable information. So when we give resources, that's when it is in there if you need to look into what needs to be confidential. So again, if we were all together, we would brainstorm some of these things that you could use for your internal controls, but just think about some of the things that you could use as internal controls, some of the things we just talked about on that list. Were there internal controls that surprised you on that list? There were some when I went over this that surprised me a little bit. Were there any of that you hadn't thought of before? Just think about how you could use these internal controls and how to implement them in your program in the future. And now we're almost at the end. Elsa will just kind of recap for us.
Thanks, Alicia. So we've covered a lot in this session, and if it didn't quite all stick, don't worry, you will get the slides as well as a glossary of terms and those sample statements that come in sort of a template form that you're welcome to use coming out shortly. And we do understand that this is just one piece of understanding your business. If you're feeling a little bit overwhelmed and you can't commit to reviewing all 3 of those financial reports, we would recommend to starting with just the income statement, because just one report can help you make better financial decisions and just get in that habit of that regular review. And then once you're comfortable with the income statement, then you might look at adding your cash flow statement. And then finally, you would add in that balance sheet to help you see the business separated from your own personal finances. So remember, while all the ideas we covered are really good examples of best business practices, start wherever you feel the greatest need. And then as we are getting ready to sign off, we would love for everyone to chat into the chat box and think about somewhere between 1 to 3 things that you learned in this session that you'd like to follow up on within your program. And Melina, if you wouldn't mind being the voice of the chat, that would
Of
be
course.
appreciated.
While they are doing that, just a couple questions here before we wrap up. In terms of the internal controls, what tips do you have to communicate new processes in a facility to people who may be not comfortable with change?
Definitely. Go ahead, Elsa.
I'm sure we both have thoughts on this. I feel like in my programs, there was always kind of a lag between writing the policy and enforcing the policy. So it would almost be like a grace period. Like you would write the policy, you would communicate it in several different ways. You would kind of like move into the gentle reminder phase, and maybe it would be like 6 months later that you're actually enforcing the policy. So just being patient can really help.
Gotcha. And then bouncing back, you touched on this a little bit at the beginning at the financial reports section, but what's probably the most used or easiest tool to use regarding financial reports for things like that?
So I think ELV's resource platform is a really great place to start if you're kind of just like at the tip of the iceberg. There's a lot of free tools and they're all relatively simple. And I would start there. I do know a lot of programs use QuickBooks or hire an outside accountant to sort of oversee things, or a bookkeeper. So those are all options. Alicia, do you have any other thoughts?
I don't on that one. I think what you said is good. On changing your policy, another thing I would add is maybe if you explain why you're changing the policy or implementing a new policy can go a long way too. That you're not just because I said so we're changing it, but because we're trying to improve our business practices, and these are the reasons why.
Yeah, gotcha. Okay, the comments coming in, we have one that says I would like to utilize the ELV resource website more, which is awesome. That's what we like to hear, whether that be core itself or the resource platform in general. And then another one we have is reviewing balance sheets every quarter, making sure the income is more than the expense, and meet with accountants consistently.
Yeah, those are great. And I think it's really important to remember it's totally fine to sort of delegate out the primary responsibilities of finances, but it's also important to sort of keep tabs on what's happening in that piece of the program so that you can ask the right questions if there's something that's not quite how it should be. In the slides, we will also have a list of other online resources. If you've gotten fairly deep into ELV's resource platform and sort of like tapped that out, there are some other sites that you can check out that'll be in the slides. And then you're also welcome to reach out to Alicia or I via email. And I think Melina will also attach the flyer for office hours if anyone wants to connect directly with further questions. And I think that's all we have.
Awesome. Thank you both so much. Thank you to all the attendees for joining and for your time today. Just as a brief reminder, you will all be getting training certificates for today's 1-hour training webinar. You will get those the beginning of next week, most likely. And just kind of common grounds, everyone already knows, the post-webinar messaging will be coming out about an hour or so after this ends, with the recording, the slides, the resources, etc. So we all hope you have a great rest of your day. We'll be letting you off just a little bit early, so get started on your weekend. But thank you all again so much. Thank you, Elisa and Elsha. We appreciate your time. Bye, everybody.